Welcome back. In our last video, we spent a bit of time looking at public and private companies. In this video, we want to dive a bit deeper into the main features, advantages, and disadvantages of being a company. Okay, on to the main features of a company. This repeats a lot of what we said before, so I'm going to keep it short and simple. Firstly, the shareholders own but do not run the business. Their shares provide finance, but otherwise, most shareholders have little to no input in the day-to-day running of the business. Instead, we have professional executives and managers that are employed to make all the business decisions. Secondly, the business and the owners are divisible. The shareholders aren't liable for any of the business's debts. The shareholders' liability is limited to their investment in the company because the company and shareholders are separate legal entities. As the business and the owners are separate, the owners can change. An owner can sell their share at any time for any reason. The legal existence and the many details of the companies are also legally recorded, and these become matters of public record. To form a company, owners of the business need to have 2 documents drawn up and registered with the appropriate government agencies, and these are a memorandum of association and an article of association. Now, the details of these are both beyond the scope of the IB Business Management syllabus, but they just detail things such as the key characteristics and activities of the business, who the executives are, and just the rights and responsibilities of each stakeholder. Not something you need to know, you just need to be aware that there are legal processes in forming a company. We also have the advantage of greater finance being available. So the IPO, and if you don't remember what this means, it's the first time that a company goes public and sells its shares public, the initial public offering. The IPO represents a one-time cash injection into the business. Then on top of that, once the business sells its shares, it receives the price paid at the IPO. A company is held to a high degree of accountability. Now, the owners and the company are separate entities. So from time to time, the company has to provide information to the stakeholders so they can understand exactly what they've invested in and how the company is being run. And so the company and its management is constantly being held accountable for their actions and decisions by the public. Information on a company comes in a lot of documents, including quarterly reports, annual general meeting minutes, or extraordinary general meetings, which are meetings called by the shareholders in exceptional cases. Companies, compared to other forms of business organizations, have far greater stability and a higher chance of continuity. When a shareholder dies or sells their shares, the company continues to operate. It has no impact on the company. All that happens is one partial owner is now replaced by another partial owner. Just as a fun fact, a company can theoretically last forever because it is independent of shareholders. The oldest company in the world is a Japanese construction company called Kongo Gumi, which was founded in 578 CE. Main features out the way, here's a summary of the advantages of operating as a company. Access to finance is easier than for sole traders than partnerships. Companies are perceived to be stable and far lower risk, so financial institutions and banks naturally are more likely to make loans to the company. The investor has limited liability. Investors can only lose the amount they have invested in shares, but nothing more. Companies also benefit from these investments because the sum of these investments from all these small investors can add up to a very large amount of money. There is continuity. Companies can go bankrupt and be liquidated, but shareholders can't be liable for that debt. Companies also have a greater chance of surviving than sole traders or partnerships. One thing we didn't mention too much is that for companies, the possibility of expansion is very genuinely real. Companies have far better conditions to expand because they generally last longer and have access to more money and resources. For a business to grow, it needs equipment, marketing efforts, new activities, and having a large amount of finance is very important to this, and companies have far easier access to money. Sole traders and partnerships don't quite get this advantage. An established organizational structure exists. Managers and workers don't have to change every time a shareholder sells a share, and this stability helps the business develop long-term relationships with customers and suppliers, and allows the business to hire people with expertise for individual positions and enhance the performance of the business. Who the owners of a business are do not affect who stays employed. Of course, with every advantage comes a disadvantage, and the disadvantages are as follows. Setting up a company takes a lot of time and costs a lot of money to fulfill even just the basic necessary legal requirements. Owners need to retain lawyers, have legally binding documents filled out, and file papers with the appropriate government agencies. All this added up is a lot of time. Selling shares when a company goes public does not guarantee that you'll get the desired or intended amount of money. Sometimes IPOs are unsuccessful and a business has sold itself for relatively little cash, so there's an element of risk there. Owners risk partial or entire loss of control over the business. If a business decides to become a company, especially a public limited company, the owner gives up some control of their business. We saw the example of Steve Jobs being kicked out the company he established. Even if a business owner retains 51% of the company's shares, which means they are the majority shareholder, they still have to answer to new owners and hear their opinions on business decisions. In the case of public companies, loss of control can be significant. Original owners can end up with only a very small percentage of the shares of the company that they established after the firm goes public. There is also a loss of privacy. A public limited company needs to fulfill its legal obligations, which includes publishing its accounts publicly. Here's the thing. A lot of people are unaccustomed to and even dislike sharing all the information publicly. If the company's performance has, for example, been weak, or sales are down, or profits are negative, the future performance can be further jeopardized because investors may withdraw their invested money. Customers may not want to purchase from a weak business that they have no confidence in, and this is a situation that can be particularly problematic for companies. A company has no control over the stock market. Think back to the 2008 Great Financial Crisis. The whole world economy might crash in an instant, you never know. Share prices may fall and the business can go bankrupt for reasons beyond their control. Even if share prices just fall, this can damage the image of a company. The loss of share value can often occur not because the company has done anything wrong, but that simply an external factor, such as an election or bad news about another business in the same industry, or a downturn in the economy, or a natural disaster has occurred. These are all things that can result in a loss of investor confidence. And so there are a lot of external elements that are beyond a business's control that can affect how they perform. Finally, a company has limited control over who buys its shares. Let's say a competitor wants to drive you out of business, and they want to do that by taking over your business, by buying it. You can't stop the company from being taken over. Companies, especially, are being vulnerable to being taken over if their share prices fall. Another business gains majority control over their business by purchasing its shares, and suddenly the company no longer is owned by its original owners. And so suddenly you no longer have control over the business. And so that concludes 3 very lengthy explanations on companies, one of the biggest and most important legal business entities and for-profit organization types in the world of business management. In our next video, we will look at certain types of businesses that are similar yet slightly different to for-profit organizations called for-profit social enterprises. Until then, take care.